Good morning, good afternoon, good evening. My name is Market Maker 69420, and in this episode, we're going to overview Trump's recent tariff changes and how they affect the economy. As of February 22nd, 2026, the landscape of Trump's tariff policies have shifted significantly. On February 20th, the U.S. Supreme Court ruled 6-3 against large portions of sweeping tariffs implemented under the Trump administration, deeming them unconstitutional or beyond executive authorities. This could lead to a refund up to $200 billion for affected companies. In response, Trump quickly imposed a new universal tariff of 10% on all imported goods, excluding certain deals, which he raised to 15% within 24 hours, the maximum allowed under current law. These changes introduced uncertainty as they replace some struck-down tariffs, but they limit Trump's leverage for aggressive threat. Retaliatory actions from trade partners, ongoing investigations, and potential legal challenges remain factors. Let's go over some key elements and analyze the potential effects on stocks, commodities, and cryptocurrency market. When looking at key factors for the stock market, tariffs generally raise input costs, disrupt supply chain, and can fuel inflation. But recent SCOTUS fueling has provided short-term relief by reducing uncertainty, leading to modest gains in major indices like the S&P 500 up 0.4%, NASDAQ up 0.6 to 0.7% post-ruling. However, the new 10 to 15% tariff could offset this. When looking at sector-specific exposure, we need to focus on industries reliant on imports, example, autos, consumer goods, tech hardware, and semiconductors, versus those that benefit from protectionism, example, domestic manufacturing and energy. Import-heavy firms may face higher costs and squeeze margins, while exporters could suffer from retaliation. For instance, a 5% tariff increase is estimated to cut S&P 500 earnings per share by 1 to 2%. Bifurcation is likely. Stocks like industrial and capital goods could rally on reduced tariffs, but ongoing probes might pressure trade-exposed sector. When looking at inflation and consumer impact, tariffs are projected to raise consumer prices by 1.2% in 2026, absorbing 55 to 70% of costs onto households and businesses. This could slow spending, causing a flat December retail sales and GDP growth down 0.4%, hurting discretionary stock. When monitoring Fed responses, if inflation rises, delayed rate cuts could pressure growth in stocks. Conversely, easing, expected in mid-2026, might boost liquidity-sensitive sector. When looking at market volatility and sentiment, tariff announcements have historically caused intraday swings, with rallies on backpedaling as seen in post-ruling. Watch for red flags like the Buffett indicator at 224%, all-time high, or Shiller PE near 40, signaling overvaluation. Uncertainty from midterm elections or constitutional crises could amplify dip, but refunds from struck-down tariffs might support earnings in affected firms. When looking at global trade dynamics, new tariffs target all imports but spare deals with around 20 countries. Retaliation from countries like EU or China could hit U.S. exporters, while supply chain shifts to countries like Mexico and Canada benefit logistical stock. Long-term, a weaker U.S. dollar from trade wars might aid multinationals. When looking at the key factors for commodities, commodities are sensitive to tariffs due to direct levies on materials like steel and aluminum and indirect effects on global demand. Post-ruling, metals surge, with gold above $5,100 and silver above $84, up 7.5%, as reduced trade barriers ease demand stock. The new tariffs could reverse some gains by hiking costs. When looking at supply chain disruption and price volatility, tariffs on raw material increase domestic prices and global imbalances. For example, higher duties on imports from China and EU could boost U.S. producers but inflate costs for manufacturers, pressuring industrial metals like copper. Watch for stockpiling and rerouting, which could spike short-term prices. When it comes to the inflation hedge roll, commodities like gold and silver often rise as safe havens during trade uncertainty or inflation, which is expected from tariffs adding 1 to 2% to CPI. A bearish long-term U.S. dollar outlook from escalating wars could further support precious metals, but stronger U.S. dollar from initial tariff strength might cap gains. When looking at demand from key sectors, slower global growth, minus 0.4% U.S. GDP hit, could dampen energy and base metal demand, while agriculture commodities might face retaliation. Energy imports like Canadian oil at 10% could stabilize if exempt, but broader tariffs risk higher oil prices from supply tensions. When it comes to geopolitical and policy shifts, we need to monitor reciprocal tariffs between 10 to 50% proposed and trade deals splintering. Commodities tied to infrastructure like steel for domestic products might benefit from America First policies, but overall, tariffs are seen as a demand shock, with gold holding up best. When it comes to key factors for the cryptocurrency market, crypto's link to tariffs is indirect, tied to macro risk sentiment, inflation, and U.S. dollar dynamic. Markets reacted positively to SCOTUS ruling, with global market cap at $2.38 trillion as it reduced trade war fears. However, new tariffs could introduce volatility, with crypto often amplifying stock moves. Trump is pro-crypto with the Potential Clarity Act, but trade policies dominate. Let's analyze. When it comes to risk sentiment and correlation, trade uncertainty drives risk-off flows, hurting crypto more than stocks, with potential 15 to 20% Nasdaq drop could drag Bitcoin harder. Post-ruling belief boosted prices, but ongoing probes or midterm politics might trigger capitulation. Crypto's performance versus Nasdaq over the next 1 to 10 years could persist if tariffs ease. When it comes to inflation and monetary policy, tariffs fuel inflation, positioning crypto, especially Bitcoin, as a hedge. Like gold, delayed Fed cuts from higher prices could pressure rates, but mid-2026 easing under new chair Kevin Warsh and liquidity injections from the $2 trillion tariff dividends and tax cuts are bullish for crypto. Hyperinflation risks from debt maturation, 26% due in 12 months, align with Bitcoin's narrative. When it comes to US dollar strength in global trade, tariffs initially strengthen the US dollar and pressure crypto prices, causing inverse correlation. Long-term weakening from wars could reverse this, aiding Bitcoin, Ethereum, and XRP. Geopolitical tensions with entities like EU and China might spur crypto adoption as a borderless asset. When it comes to regulatory and sector-specific ties, Trump's crypto-friendly stance, like CME's 24/7 futures launch in May, could mitigate tariff downsides. Watch the volatility in altcoins tied to tech/supply chain, like Ethereum from DeFi exposure. No major downside from tariffs per se, but alignment with broader market rallies post-correction. These factors are all interconnected. Inflation from tariffs affect all markets, so monitor real-time developments like Fed decision, retaliation, and economic data for holistic analysis. All right, that's all I got for you guys today. If you like this episode, don't forget to like, comment, and subscribe. Bye-bye.